Up until now, in Chapter 13, we've been focusing on the money supply. How is the money supply affected whenever the Fed engages in different monetary policies? How is the money supply affected if we change the required reserve ratio or the discount rate, or we change the order of operations whenever we're buying and selling those government securities? So we've talked pretty extensively about the money supply, but now we're going to start diving into this money market equilibrium. And what the other component that we need to find this money market equilibrium is the demand for money. So whenever we start talking about the demand for money, we're typically talking about the demand for cash, or the demand for those checkable deposits, the demand to actually hold money that we can buy things immediately with, not necessarily assets. We're not going to place that money in assets. We're going to talk about trying to obtain the demand for that cash, or those checkable deposits that we can go out and buy things with. So the first question we have to ask ourselves is, why do people hold part of their wealth in money rather than place all of their wealth in income earning assets? Why aren't we going to take our money and place it all in assets that are going to earn us money? Why do we keep some cash? Why do we keep some checkable deposits? And then the second question that we're going to ask and address with this money market equilibrium, specifically the demand for money, is what will happen to the interest rate, or what happens to the interest rate if the demand for money increases or decreases? What is going to be happening to the interest rates by whenever we start demanding more money or we demand less money? What's going to happen to that in that aspect? So first off, the demand for money. Why do we hold money? Why do we hold that cash? Well, we hold that cash for three main reasons. The first is transaction demand for money. There is a transactional or transaction demand for money. The second reason that we hold the money, or that we have a demand for money, is a precautionary demand for money. And then the last one is a speculative demand for money. So let's dive into these three, shall we? First off, let's dive into the transactional demand for money. Households hold money since it is widely accepted as a medium of exchange. There's that transactional aspect. We are going to hold money in order to buy goods and services. Because money is considered, is widely accepted as a medium of exchange, we can hold money in order to go and buy things with. And actually, we're willing to accept money for the things that we sell. So households are going to hold money so that way we can buy and sell things, or to buy goods and services. And as we continue on with that transactional demand for money, another reason that we're going to hold cash is because the receipts of money does not always match the timing of spending. So what that means is, when you receive that money, does not always line up with when you're going to be spending that money. So when you get paid does not always match when you need to buy things. So think about that in your job, or at a position that you've worked at before, or a job you've worked at before that you're currently working at. You'll get paid from that job. Maybe it's every other week, maybe it's once a month, maybe it's every week. But when you get paid does not always match when you need to be buying things. When your bills are due does not always match when you're getting paid. So because of that, we are actually going to hold money to cover costs. We're going to place money in our checking accounts and leave it there rather than investing it in an interest earning asset. We're going to leave money in our checking account. Maybe we get paid at the beginning of the month, and we're going to leave money in our checking account all the way through the end of the month to cover our expenses, because when we get paid does not always match when we're going to be buying things. So that's the second component of that transactional demand for money. The first is we can buy things with it. The second is we're going to hold on to it so that way we can buy things, because when we get paid does not always match when we're actually going to need to buy things. And then the last aspect of it is the cost of not having transactional balances is the rate of interest needed to borrow money. So what if you didn't actually hold money to cover those costs? What if you didn't actually hold that money in your account as a checkable deposits or anything like that? Well, whenever you needed to go buy something, you'd have to borrow that money. So what's the cost of borrowing the money? Well, the cost of borrowing that money is that rate of interest. So if you didn't have the cash, what could you do? You could borrow it, but now you're paying that interest. So one of the aspects of this transactional demand for money is we don't want to have to pay interest. We don't want to have to borrow money and actually have to pay that interest. So guess what we're going to do? we're just going to demand and hold on to that cash so that way we could buy things when we need it, buy those goods and services when we need it without actually having to pay that interest. So that's a component of transactional demand for money. The second aspect of this demand for money is this precautionary demand for money. So we are actually going to be demanding more money, or we're going to hold more money when the prices of assets are falling because the nominal value of money is fixed. So what does this mean? Well, what that means is that nominal value of money is fixed. So a $100 bill today is worth $100 is worth in nominal values tomorrow, and it's worth $100 a year from now. A $100 bill will continue to be worth $100 in nominal value. Now, because of interest and because of the inflation, or not interest, but because of inflation, we know that the purchasing power of the dollar is typically falling, but a $100 bill is still worth $100 in nominal value. So, what if we took that $100 and put it in stocks? Well, the stocks may increase in value, but it may also lose value. So if we invested money in an asset, we're worried that that asset is actually going to lose value. So if we're worried about that, then we might be willing to keep more money in cash as a precautionary measure to make sure that our assets don't lose value. So let's think about that in agriculture. What if you decided to go out and buy a hog, or buy a calf, or buy a lamb, buy a sheep, or you buy some type of livestock, and you buy this because you're expecting to feed this animal out and then try to sell it at a higher price later? Where you're taking a gamble because that value of that animal the livestock prices may fall in the future. So you buy this animal with the hopes that the value stays the same or actually increases, but it could lose value. So if you're worried about that asset losing value, then you might actually decide, well, instead of investing in that, I'm just going to hold that as cash because I know my cash isn't going to lose value. It's not going to lose that nominal value. So the second aspect of that demand for money is to actually hold money, is that precautionary demand for money, is to hold money as cash because the nominal value is fixed. But if we invested in an asset, the asset may lose value. And then the last reason is this speculative demand for money. So the speculative demand for money states that we actually have an increases in demand for money in a recessionary economy whenever asset prices fall. So as asset prices fall, people tend to hold on to more money. It kind of goes a little bit along those precautionary aspects that you're worried about the asset prices falling. But here is more specifically in a recessionary economy. If we get into a recessionary economy and we're worried about assets, the prices of assets falling, we're not going to be investing in assets. We're going to be holding on to our cash because we're speculating that that cash is going to be worth more than those assets because that asset value is falling. So essentially a quick recap, we have demand for money, demand for cash. The reasons why we're going to hold money. First off is that transactional demand for money. We want to make sure that we can actually buy things with it. We don't want to have to pay interest on loans. So we're going to hold on to money so that way we can buy things. The second aspect is a precautionary demand for money. We are worried that if we take our money and invest it in an asset, that asset may lose value. We don't want it to lose value, but we know that the $100 bill or the amount of cash that we have today is going to be worth the same in nominal values in the future. So if we're worried about an asset falling, losing value, we're going to retain that money. And then the last aspect is a speculative demand for money. That if we get into a recessionary economy and we're worried about asset prices falling, we are actually going to retain more money. We're going to hold on to more money because it doesn't make sense to place it in that money in assets that we're worried about the prices falling.